Cost controls have been the narrative on Main Street, but it's a different story on K Street. And that's where we start today with America's deficit problem and CBO Director Phillip Swagel, along with senior economics reporter Steve Liesman. Hello to both of you. Steve, kick us off.
Yeah, Kelly, I think people need to understand with the stock market so focused on the bond market and the bond market watching the Treasury issuance and deficits, there's no better person to have here than the director of the CBO, Phil Swagel. Phil, thanks for joining us.
Steve, thanks so much. It's really a pleasure.
So I have a sort of a strange question to start off with here. I lost a little bit of hair in the last couple of weeks trying to understand, is it a $1.7 trillion deficit or a $2 trillion deficit? When you're at a cocktail party, Phil, which number do you use?
No, it's a complication. What I say is that the deficit doubled from $1 trillion in 2022 to $2 trillion in 2023. And the complication, as you're hinting at, is that I'm, in a sense, setting aside the cancellation of student debt that never happened and that, got booked into the deficit numbers, then unbooked. And, it sort of confuses the issue. Yeah, so that's why I say the deficit doubled from $1 to $2 trillion.
Okay, so let's talk about what we call the road to $2 trillion, because I felt like I turned around, it was 1.5, then all of a sudden it was 2, and it was in all aspects of government finance. The biggest chunk was revenue, and my question is not what happened with revenue, because we have it on the chart. It went terrible, and it was likely capital gains. So my question is are you expecting those lousy revenue numbers to continue?
Yeah, that is the key question in the near-term deficit outlook. As you said, we had weak revenues, as your chart showed. Capital gains looks to have been a big piece of that. We'll learn more over time. We have those coming back and a more of a traditional relationship between capital gains and the economy. So it looks like that was a one-off. And there's some other one-offs, is like the employee retention tax credit. Looks like it was a one-off, and some other things that were like one-off revenue weaknesses. So hopefully that won't be an issue in the future.
All right, but back to the road to $2 trillion. What may not be a one-off is that $177 billion extra we spent in interest payments. I have a little sympathy for you, Phil, which is how do you forecast what interest payments are going to be when in the last week the 10-year is down 0.5 percentage point, it was up to 5? What's your forecast for what's going to happen to interest expense as a percent of total spending by the government?
It's the biggest challenge we face in updating our budget projections. We're at the beginning of that process now. So over the next couple of weeks, we're going to finalize our forecast. The run-up in rates from the 3.8 that we had a year ago in our forecast to just over 4.5 has added over $2 trillion in net interest outlays to the 10-year outlook. If interest rates had gone up and stayed higher like they were a couple weeks ago, that would be almost another trillion. So yeah, the kind of week-to-week volatility we have over 10 years with a big debt stock makes a really big difference in the fiscal trajectory.
And Phil, it's Kelly here. If I could pick up on that, it does look like the projections for the next decade or so show that half of the deficit, which is going to remain wide, would be driven by interest costs. What would the 10-year have to get down to, just to pick a figure? You can use 10-year, use whatever you want, but what do rates have to get down to in order to keep the debt from growing and to keep the deficit from being at historically large proportions?
Yeah, no, Kelly, you put your finger on the really difficult part, is that, we have high and rising interest outlays, but then the primary deficit, right, the deficit other than interest payments is also wide. And that's the challenge, that even if rates went back down to the kind of 3.8 level on the 10-year that we thought a year ago, right, that would help. But the deficit would still be wide. We'd still be talking about trillion-dollar deficits, more than 5% of GDP into the future, just because of the primary deficit, because of everything else. So rates can help, but even low rates by themselves don't stabilize the fiscal situation.